Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications. Hello, everyone, and welcome to Copy Stock Guru, the show that takes you through the investment strategies of the world's greatest stock gurus. Today, we have Tom with us to analyze a common misconception.
Hello, everyone. Joy is exactly right. Today, we're going to talk about something many people misunderstand: the idea that Warren Buffett doesn't like technology stocks.
Right. A lot of people think that he's old-fashioned and refuses to invest in tech, but that's not the case at all, is it, Tom?
Exactly. I've been doing some deep research on this. The first thing we need to understand is that Buffett doesn't invest based on the industry, but rather on the business itself.
Oh, please explain. What are the main principles he uses to make decisions?
There are two key principles. The first is the circle of competence. Simply put, this means you only invest in businesses you truly understand, not just businesses you've heard of.
So it's like we shouldn't buy stock in a company if we don't know what it does, right?
Yes, but it's much deeper than that. Buffett wants to understand a business well enough to predict its future cash flow. In the past, tech businesses changed so fast that it was too difficult to predict.
And what's the second principle?
The second is economic moats. Think of an ancient castle with a moat surrounding it, protecting it from enemies.
This is a competitive advantage that makes it hard for rivals to compete, right?
Exactly. For example, Coca-Cola has a strong brand that people all over the world recognize, and it's not easy for anyone to replace it. Or American Express, which has a huge financial network that customers are loyal to and don't want to switch from.
I see. But then why did he invest in Apple? That's a clear tech stock.
This is the interesting part. His investment in Apple in 2016 wasn't a change of mind. It was him applying his old principles to a new context.
What do you mean by that?
Buffett didn't see Apple as a tech company. He saw it as a consumer brand with a strong pricing power.
So the iPhone is like the Coca-Cola of smartphones?
You got it, Joy. The iPhone has a sticky product because customers are so used to the iOS system that they don't want to switch to another brand.
What about Apple's economic moat?
Apple has a very modern moat, which is its ecosystem. The iPhone, iPad, MacBook, and Apple Watch all connect seamlessly, making it hard for customers to leave for another brand.
So if you switch to Samsung, you have to replace everything, right?
Exactly. That's what's called a high switching cost. This isn't just about money, but also the time, hassle, and effort of learning a new system.
That's fascinating. But recently, there was news that Berkshire Hathaway sold some Apple shares. What does that mean?
That's a great question, and it's another common misconception. Many people think it was a change of heart, but there were very logical reasons for it.
What were they?
The first reason was portfolio rebalancing. Apple had grown to be too big a portion of the portfolio, almost 40%. That's very risky. If Apple stock took a big hit, Berkshire would be in a lot of pain.
So it's like not putting all your eggs in one basket?
That's right. The second reason was taxes. Buffett was concerned that the government might increase capital gains taxes in the future, so he sold some shares to realize gains before the taxes went up.
Oh, that's smart. Any other reasons?
Yes, it was also to prepare for the succession. Buffett is now 94. He wanted to make sure Greg Abel, his likely successor, has enough cash to make his own investments and build his own record.
I understand. And what about Berkshire's other tech investments, like Amazon and VeriSign?
That's an important point. Most of those investments were not Buffett's decisions. They were made by his fund managers, Todd Combs and Ted Weschler.
So he has other people helping him decide?
Yes, Buffett gave them about 10% of the portfolio to manage. He himself said that the Amazon purchase was a decision made by his colleagues, not him.
I see. So for the average investor, what lessons can we learn from Buffett?
First, don't judge a business by its industry label. Look at the business model instead.
For example, Netflix isn't just a tech company. It's a media company with high switching costs.
So when we look at Netflix, we should think of it as a movie and TV series company, not a tech company.
Exactly. And you have to ask yourself, what are Netflix's moats? Does it have exclusive content that others don't have? Does it have user data that helps it recommend movies accurately?
And what's the second lesson?
It's to invest in yourself. Buffett says this is the best investment you can make. Reading books and learning about new businesses will help you expand your circle of competence.
Just like Buffett himself learned about Apple until he understood the business and was confident enough to make a big investment?
Perfect. He didn't change his mind about technology. He expanded his understanding and saw that Apple had all the qualities he looks for.
So, to summarize, what should we look for if we want to invest in tech stocks?
First, see if the company has a strong brand that customers love and don't want to leave. For example, iPhone users are loyal and don't want to switch to Android.
Second,
See if it has an ecosystem that locks customers in. Apple has the App Store, iCloud, and AirPods, all of which work together seamlessly. If you switch to Samsung, you lose that convenience.
and the third thing?
Look at the cash flow. The company needs to be able to generate real cash, not just have a cool idea or technology. Apple is a great example. It generates a huge amount of cash and can continuously buy back its own shares.
What's so good about a company buying back shares?
When a company buys back shares, there are fewer shares on the market, but the company's profit stays the same. So earnings per share automatically goes up. It's like a pie with fewer people sharing it. Everyone gets a bigger slice.
That's brilliant. What other tech stocks are interesting right now based on Buffett's principles?
You have to look at each case. For example, Microsoft has Office Suite, which is used by businesses all over the world and is difficult to switch from. Google has its search engine, which dominates the market and has strong network effects.
What do network effects mean?
It means the more people who use a product, the more useful it becomes. The more people who use Google, the more accurate its search results become. The more advertisers who use it, the richer Google gets. It's a great cycle.
What's a common mistake investors make with tech stocks?
The biggest mistake is getting dazzled by the technology without seeing if it can actually make money. For example, during the crypto boom, many people bought shares of companies with blockchain in their name, but didn't look at the business model.
Or like the current AI hype where every company claims to use AI.
Exactly. You need to see if the AI actually helps the company cut costs or increase revenue, or if it's just a marketing strategy.
So for someone who's just starting to invest, where should they begin?
Start by learning to read financial statements. Understand what profit, cash flow, and debt are. Then you can see which companies have an economic moat that you understand.
Are there any tech stocks that are good for beginners?
Microsoft is interesting. Its business is pretty easy to understand, with Office and Windows, which people need for work. The brand is strong, and its cloud business, Azure, is growing well.
And what about Google?
Google is a good one, but it's a bit harder because its main revenue comes from advertising, which can be volatile with the global economy. But if you understand the digital advertising business, it's a great choice.
All right. Before we end the show, could you give our listeners some key takeaways?
Sure. The simple summary is that Buffett doesn't dislike technology. He only invests in excellent businesses, regardless of the industry.
And we should learn to look past the industry label and look at the quality of the business, right?
Correct. Find a company with strong economic moats that generates good cash flow and is within your circle of competence.
And finally, Buffett selling Apple shares doesn't mean he changed his mind about tech, but rather that he's a smart risk manager.
Yes, and that's the most important lesson. Good investing requires both long-term conviction and the flexibility to adapt.
Thank you so much, Tom, for this great information. And to all our listeners, remember to do your own research. Most importantly, invest in your own education before investing in any stock.
That's right. We'll see you in the next episode.
Bye-bye.
Bye-bye, Ga.